Fast fact. The total dollar volume of commercial real estate transactions in 2024 reached $757 billion, an increase of over 12%, or $85 billion since 2023. I'm Drew Thomas, and you're listening to Bank Chats. We are talking today about, we have an interesting guest with us today, and I'll let him introduce himself in just a minute, but this started because we were starting to think about some of you drive past these buildings and stuff that you come to work and you see the sky, so cranes and stuff like that.
New development,
Yeah, and you start thinking about how in the world does that get built, right? Because J.D. Rockefeller's dead. He's not building his own buildings anymore, right? 30 Rock is not the way that this stuff is done these days. And you got to wonder, how much money is invested in these buildings, and are they really, making
what the
money?
Process is, yeah.
Yeah, and then also, who's involved in making that happen? Does every tenant that ends up in that building, do they end up paying part of it through rent to pay the building off, or how does this? So we have somebody that works for the bank. You work for the bank now, right? Yeah. And who can talk about some of this stuff. So I'm going to literally, this is Justin Mazer. I'm going to let him introduce himself, tell a little bit about what do you do for, what is your job? What do you do?
So I am the Senior Vice President and the Director of Specialty Real Estate, which is basically something that we have within the trust division of the bank. And what we do is we run what is called the EREC funds, which are the Employee Real Estate Construction Trust funds. And they're kind of a special alternative investment type where we accept union pension money into the fund, and then we invest that pension money into real estate projects within the local geographical area of the pensions. And at the same time, while we're investing to get a return for those projects, we are also requiring 100% union labor on all construction projects that we invest in, which then basically creates jobs for the unions along with performance returns from our investments in these real estate projects.
Okay. So we're going to talk about that, and we're going to talk about it in a way that most of us will understand.
Yeah, because you've told me that twice, and I still don't get it. So let's break it down a little bit more.
Absolutely.
So from what I'm hearing, basically, when companies, and I'm guessing it's companies, when companies want to invest in a new building or want to in new construction, obviously they need funding.
Correct.
Right. And like I said, there's not a lot of independently wealthy people out there just building their own stuff these days. Right. So is it usually a group of, you said that this is with union labor, right? So is this a group of unions that usually put these buildings together, or how does that work?
No, so what we do is we actually reach out to developers that are active in the area. So we're mainly in Pittsburgh and Cleveland markets, so we have a lot of active clients in those markets, and they're developers, they're development companies, and this is all they do is develop real estate. They have specialties. Some of them are specialized in office buildings. Some of them specialize in apartment buildings. Some of them specialize in industrial buildings. Mm-hmm. But they have their niche. They know what they do well, and we work with them. Basically, they come up with the idea, hey, this is where we want to put the project. This is what we want to do. This is our game plan. And then they come to us and ask us for money. How can we help them?
Okay.
I could go on here a little bit. So when they start this process, they have a banking relationship already. Majority of development companies, they're going to have relationships with a lot larger banks, regional size banks, because they're asking for significant amounts of money,
So are they going and saying, hey, I need a $200 million loan to build a building, or is it?
So what I will say is the buildings, just to give you an example, the buildings that we typically get involved are between the $50 and $100 million buildings. Okay. So when they want to go, they're looking to get basically.
So not that expensive is what you're saying.
Well, we build buildings that have been worth, $200 million and $250 million. So But we try to keep in the niche of 50 to 100. And yeah, that's probably a lot for most people. But for us,
it's a lot for me. I can tell you that right now. Yeah.
it's a normal thing for us. We consider that more of a mid-tier market, like small.
A little easier to get funded. Or,
Yes, yeah. And so what happens is, if they go to the bank, they talk to the bank, and the bank, of course, is going to tell them, you're building $100 million building. I'm not giving you $100 million. The bank is saying, and today, back in the day, they might have said, we'll give you $80 million to start this $100 million building. But today that's down. It's not $80 million, it's $60 million. So now you're building a $100 million building, you're getting $60 million from the bank. So the developer has to come up with an additional $40 million. And that's where we come in at that point.
Okay. So to put this in the perspective of an average person, like, if you're buying a house, right?
Yep.
Chances are your bank is probably not, the bank wants to have a little bit of probably equity in that house. So
Absolutely.
So they're giving you a loan value that is not necessarily 100% of the value of the house. They're saying like, well, we'll loan you, what we feel is probably 90% of the value of the house or something.
You got to
like
take
that.
care of the down payment. Yeah.
Yeah,
The down payment.
Exactly.
That's exactly
So you got to do the down payment or whatever.
Right.
How you do that, there's different ways to do that, but it's essentially the same thing. Like the bank is taking a risk in terms of fronting all that money. So what you're saying is they're less and less willing to take large risks on the event that these buildings don't make money.
Correct. Absolutely.
Right. Okay. So and then so you said that's where the erect funds comes in, right?
Absolutely. Yeah. And that was a good analogy because when you're buying a house, you do have to put that equity, that down payment down, whether, you're buying $100,000 house, you should have $20,000 down, right? Well, $20,000, not much. You can raise it, maybe talk to friends and family. Maybe you could save for that. $40 million, you're not saving for that. You need to come up with other people to help you kind of lift that. And so kind of why we gain traction in our markets where we're at today is, if you're raising $40 million and you're going to friends and family to talk about this and, trying to get them to buy into this project, even if you have very wealthy friends and family, they're only going to give you 200, maybe 500,000, maybe $1 million. So you're going to need 40, 80, 120 discussions with 120 people. I mean, it's a long haul. And that is why we've kind of come in as we are basically one person, not person, but an entity, and we can do a much larger portion of that 40 million. So we may not do the whole 40 million, but maybe we do half. So we'll give them 20 million. But we underwrite a project. The big thing, the difference here too is we're experts in real estate. Whereas if you're going to friends and family, you have to explain the project. You have to talk about it. You have to explain how they're going to make their money back, how things, how you're going to get paid back whenever you put this $100,000 investment. How long is that going to take? Because when buildings get built, you're not getting a return on that money. So you're going to, that it's going to take years until you see that return.
Which makes for some very awkward Thanksgivings. Is what you're saying.
Nice
saying.
turkey. Where's my million?
Yeah, right.
Exactly.
Yeah, this is great. How'd you afford that, Mildred? It's like,
especially if you have 40 of those people out there or 80 of them to deal with. Yeah. So since we have this background and we understand these things, we underwrite these like a bank would underwrite them, but we underwrite them based on what position that we get into the project. So that $40 million, we could be in many different types of products because there's not just a one size fits all product for that. But at the same time, we have a better idea of that because this is what we do for a living.
Yeah.
Makes it easier. It's really trying to make it easier for the developer to get this deal done. But the other side of that is, your friends and family aren't going to question you about, does this number make sense? Or is this a little off? Or, are these numbers accurate? Whereas since we do this for a living and we're kind of experts, we know what to look at. We know what to check when they're when they're saying we're going to make this money back on X number of days or whatever. We actually have as much, if not more information than the development team does. So because this is what we do. This is all we do. We only do construction loans. So we only do these things. We have, developers might build 3 or 4 projects a year, if they even, maybe 1, 2, if they're not super big. We're doing 8 to 10 deals a year. So we're looking at 8 to 10 different things. So we have a better understanding of the markets that we're investing in. We have a better understanding of the tenants and what's going on. So we are harder on the developers too. So there's a trade-off there both ways, you know.
So, oh, go ahead.
No, I was just going to ask. So, these investors that are investing into these funds, do we have long-term investors, or do you have to find new investors for each project?
Yeah, so we basically, the way it works is the pool of the money in the erect funds comes from the union building trades and from other pension money from counties and the state and stuff like that. And what that money is sitting there for us to use for these projects on a regular basis. And what happens is the way the pool kind of works, the erect funds, the way the pool is, you know, we try to invest 100% into the construction projects. But as you know, loans pay off, investments pay off. So we constantly have this churn where we're putting out money for new projects, but at the same time, we're getting money back from existing projects.
Okay.
And so the money continues to churn back and forth, back and forth, back and forth. And we try to keep the cash balances as low as possible. But at the same time, you know, the goal is to keep it fully invested, but we still need that churn so that we have more money for more projects on a constant basis.
Yeah, you said something interesting there. I didn't realize happens. Loans pay off. I was mine don't.
For some people, yeah.
That's a different subject.
That's a different thing. No, I think that's really, really cool, because those buildings, and this kind of goes, I think, to what Jeff and I were thinking about is, you know, these buildings, it's not just the building that makes a difference in those communities either, you know, but we can get into that. But what kinds of project, you said that you usually deal with $50 to $100 million projects, whatever, but what kinds of projects are there? Like, what kind of, are these like manufacturing places? Are these retail places? Like, who builds buildings like this, and what do they usually put in them when you fund them? Like,
absolutely. So we're broad spectrum. We basically will invest in any type of property type. We stick with the core stuff, and not anymore, but up until 2020, one of our major property types was office properties. They were always in demand. They were always good at attracting tenants and stuff like that. Today, that's a different topic. Everybody knows what's happened with the pandemic. Office properties are struggling. I mean, actually, I've actually just read an article. I can't remember who wrote the article, but they actually said that there are more office buildings closing than opening for the first time in like decades, which is not surprising. We also one of our big investments right now are apartment buildings. They're very hot right now. As everybody knows, the real estate market, even for single family homes, prices are up. In a lot of places, rents are more affordable than having a mortgage right now. And so there is a high demand right now for apartment buildings. The other thing we do is industrial buildings. And when I say industrial buildings, these are not manufacturing buildings. These are not industrial in the sense that we would think of. Industrial buildings now are mainly warehouses for shipping products. That is really things have changed in the industrial market, and it's more tied to, you know, warehousing and distribution facilities. So that's another type. But honestly, we've done all kinds of things. We've done retail. Retail is very hard to do, as everybody knows.
It's probably like office buildings. Retail is not as popular as it once was either. There's a lot of malls around the country that'll tell you that. I mean, it's, you know.
Absolutely. Yeah. And the other thing with retail is, you know, as everything is, retail has totally changed. I think retail is more, it's not so much retail as the clothing stores and the big box stores and things like that. More of it is local and smaller scale retail things. And those types of things are probably outside of our expertise because they're just not big enough for us to do. So we have a hard time in that. But we've done self-storage centers as well. That's a different type of property.
Yeah. So I mean, so basically any type of property, but theoretically that property has to then turn around and make money then, right? I mean, that's, you know, but those properties also, and this is what I was maybe getting to a little bit ago, those properties also help the communities that they're in grow, I would have to think. Because anytime something new comes up, you usually find that there are things that sort of pop up around it.
Absolutely.
Right? So what you guys are doing is not only funding that particular project, but theoretically, you're helping to fund the growth of a community.
Yeah, absolutely. And that, honestly, that is what I like to call it, like the ripple effect of what the funds do. So yeah, we build the building, which is nice and makes us a return and everything like that. But when we built the office building, you bring tenants in. Those tenants then are creating jobs in the neighborhood. Well, when people are in a neighborhood and they have jobs, they like to eat lunch usually. So typically what happens is restaurants start popping up so that people can eat. You'll get more retail development. And then as you get more retail development from that, then eventually people need to live there. So then the apartments come. It's like, it's a cycle. And
it's a sort of a snowballing effect, you see, but you got to start with something small and then it grows.
Absolutely. And to be honest with you, like the Erect funds have seen this happen in a number of our projects because we're in the business of doing things that most other places aren't going to do. Other banks aren't going to do these types of loans. They don't want to. They don't want to be involved. So we have to be. We're willing to do things that most people can't.
So why is that? Oh, sorry.
No, I was going to say. So this is just a kind of an us thing. I mean, other banks don't do this.
Absolutely, yes. It's very unique to us, and it's because it's risky. And the thing is the risk pays off. Because it's risk and reward, but you have to have people that know what they're doing. And the thing is the Erect funds have been around for 38 years. So they have a track record that can be trusted because we've done this for 38 years.
It's hard to build something like this overnight.
Exactly. It's hard to do something like this from scratch today. Yeah. It would be almost impossible, really.
So I don't know if you're allowed to drop like, names or anything like that, but what are some projects that people, obviously if you're listening to this in California, you're probably not going to know this, but if you happen to be in Western Pennsylvania or Ohio, what are some of the projects that you guys have helped to make happen?
Yeah, so we've done one of the big projects that was kind of the catalyst for a major neighborhood in Pittsburgh. We helped finance Bakery Square, which was it's a big development in the East Liberty section of Pittsburgh, and it started as one little thing, and it's kind of just expanded. That entire neighborhood has changed over the last 16 years that I've been involved with the funds. We also have done a similar thing down in the Strip District of Pittsburgh. We did what was called the Cork Factory Apartments in Pittsburgh, and everybody told us we were crazy to even invest in this. It was a major renovation in a section of the city where there weren't too many residents to begin with. Well, that first one led to 2 more types, and then from that point, it's kind of the Strip District has totally changed over the last 20 years. Anybody that's been to Pittsburgh will tell you it's a totally different place. But honestly, we went down there and did the deal with the Cork Factory when we didn't really know that was a good spot or not. We took the chance. We had a good developer. We had a developer that knew what they were doing. They had a good idea. But the reality is it's a risk. It's an unproven market. It's an unproven product in an unproven market. And you have to have people that know what they're doing in order to feel comfortable with taking that type of risk.
I kind of get where you're coming from when it comes to the growth of the communities and that you're in. And I know that we were talking a little bit that you guys didn't have anything directly to do with the area around the waterfront, but I remember when I was a teenager, I remember going with a friend of mine. We were going to a Pirates game back when the Pirates were worth going to see. And and I guess they're not going to be sending me any merch. But so we were going to, and we decided on the way, we're like, wow, the ball field is going to be, super expensive. Why don't we just stop someplace and get something to eat, on the way? So we get off in Homestead, right? And this is, if you're not familiar with the Pittsburgh area, Homestead was bad. I mean, it was a rough neighborhood. And we went to an Eaton Park, which is a Pittsburgh staple. And we went to this Eaton Park and we go in and they say, it says like the whole, please wait to be seated thing or whatever. We stood there for 10 minutes. Nobody, there were people there, but nobody approached us. So then the one waitress finally said, well, just grab a seat anywhere. So we did. And we sat at the table for another 10 minutes and nobody came around. So we left there. And then we ended up going to a to another fast food joint or whatever down the street. There was nobody in it. It was a KFC. We walked in. There were no employees. There was nobody there. It was the craziest thing. And so now when I go back and we left, I mean, we just, because it was, and like there were restaurants and that were obviously previously fast food joints and stuff that just had like they were falling apart. There was graffiti all over the place, whatever. 20 years later, it was a completely different place. because somebody put some investment in there and they put some retail in, they put some shopping in, and now there's a comedy club there, there's hotels, there's a huge movie theater, all this kind of stuff. So I get what you're saying about some of these places, just these investments. They're not just for that building. They invest in a whole community.
Yeah, absolutely. And honestly, part of it is, if you're going to take that chance, you're going to take that risk in an area that is not hot right now, that it's maybe this is an area that, you think has potential. I mean, it's hard to get people on board with that because, if you go to, if you go to an area like that is run down a little bit, most people are going to look at it and say, I don't want to invest in that area, because how do you know that somebody's going to come? How you going to, and honestly, that's why it takes a team. And honestly, the Erect Funds is part of that team because, when you go to a bank, your banker tries to help you and tries to tell you like, this is the way it works and this, that, and the other. But most banks don't have, smaller banks, community banks don't have dedicated construction lenders. That's all they do is development lending. That's not usual. Even in larger banks, it's hard. You might have a guy that specializes in development lending, but he's probably not doing, 10 deals a year because it's a hard business to get into. That's all we do. So we help, because that's all we do, we're helping the developers. We can actually pick and say like, okay, we can see what their thoughts are for the future. How does this community actually grow? Because we've watched it in other times. And if you haven't done that, it's hard to do. I mean, it's hard to
something to compare it to. Yeah,
exactly. And it's like, if you don't, it's a nice thing for us because we have that expertise and we can kind of play off of that. But honestly, we actually help the banks because the banks typically, I will just be honest, a lot of the banks that work, the senior lenders on these deals that we get involved with, a lot of them are like, if the Erect Funds are involved in this deal, can we talk to them? Can they give us some insights as well? A number of banks, they get more comfortable with deals whenever developers go and say, well, just so you know, this is a Erect Fund project. And then the banks are like, oh, well, we know the Erect Funds know what they're doing, so we can support this as well. So we work directly with banks. We think of us as competition, but realistically, we work with the banks to kind of help them along too. They don't have that dedicated development lending staff. We do. That's what we are. So
do these developers, they go to the Erect Fund first before they go to the banks?
So most of them, what they'll do is they know that they can get a first mortgage loan. Most people know that you can get a first mortgage. Banks are willing to give money out pretty much on anything, but you don't know what the terms are on those. So they know that they're going to be able to get that. Their biggest concern is coming up with that gap money, that $40 million. Yeah. And so they start coming to us first, and they do come to us, and they tend to help us. They tend to bring us in early because if they get buy-in from us, that helps them with their thing, but it also helps them when they go to select their lender, and to get terms with their lender.
And this is not the first thing they've built, so they kind of know what they're going to get from the bank. Okay.
Absolutely. Yeah.
Yep. I think it's not something that I think a lot of people think about. They don't. That's why we didn't. I don't know what made us think about the fact that but really it's just, you see these things go up and you're like, oh, somebody's building a new building, but nobody ever thinks about, well, somebody's paying for it.
Like that's expensive. That's how it started.
Yeah,
and I don't think people understand how long it takes to build a building. Like I think people say, oh, well, they're building that building and it'll be built in 2 years, but it took 5 years to get that money lined up. It takes long stretches of time. And, in a world that we live in now, things change quickly. So if you're, planning on building an office building, if you were planning on building an office building in 2019, that was the beginning of it. And then, it takes 3 years lead time. More than likely, you lost that building. You just scrapped the plan, but you spent 3 years on it before you scrapped it. So it's like, it takes a long time to build a large building. I mean, I don't think people realize the scope of it between the lead up time and then the construction time. All told, you're probably looking at 6 to 8 years for any type of development.
Wow.
Now, whenever one of these buildings comes up for you guys to consider, one of these projects, right? Do you then say, well, who's going to occupy the building? Do you have to, if it's an apartment building, do they have to try to rent those apartments ahead of time? There was a place in State College that I used to drive past when I used to deliver blood, and it was the Frazier Complex, I think it was called, and it looked like it had just they broke ground, and then nothing ever happened for like 2 years, because and what I later found out was that they were having a hard time renting the apartments, so they weren't accelerating the progress on the building because they were like, well, we're going to build it and it's going to be empty.
Right. Right. So again, this goes back to like this, since we do this all the time, we have a very good idea of where to put an apartment building, because with apartments, the biggest thing is location. It's all about location, because if you build that
I've heard that
apartment-
before.
yeah, housing, location.
Location. Yeah.
It's the same thing with apartment buildings. Like if you think about it, it's really the same thing with any property type. The location is literally the key to anything, because you're not going to build an industrial building. You're not going to build a warehouse and distribution center in a residential neighborhood. Like, let's just say Oakland in Pittsburgh. It is where the University of Pittsburgh is. You're not putting a distribution center in the middle of Pittsburgh.
Right.
But that's a very good place for an apartment building. You're also not building an apartment building at an interstate interchange, because nobody wants to live at an interchange. So it's the big thing with that is like the apartment building, it's not going to be leased until it gets built. But you can have a good idea of how is that neighborhood leasing? How are the apartments that exist there now? Is there demand? Are they leased up? Is their occupancy in the 80%, 90% range? Or are they in the 50 and 60% range? You take the data from the market and kind of analyze it and see, and then we make our estimate or our best educated guess based on the data that we have at that point in time. But again, data changes constantly, so we have to stay on top of this daily.
Yeah. I just can't admit that doing this and like doing marketing the way we do, doing podcasts and stuff. I mean, things change quickly, but it doesn't. There's not lives hanging in the balance if we don't our lives are hanging in the balance too, if we don't do, but nobody else's are. But I just I want to circle back just because I don't think we touched on a lot of it, but you had said something about the unions that are involved in the Erect funds reinvesting in their own retirement. Is that what it is?
Yeah.
So
what this is basically, the funds are set up to basically hold pension money and health and welfare money, which is basically specific money that unions have as benefits for their employees. And one of the things is, they take their pension money through their trustees and their investment consultants and whatnot, and they decide, hey, we're going to invest in the Erect funds. And then we go and start investing it within the projects. Well, when those projects begin construction work, the one stipulation of the Erect funds is that it has to be built using 100% union labor. And that's very important to the funds. It's very important to us, and it's very important to the unions. The reality is, my personal opinion, I can't tell you off the top of my head, but I would say I've been involved with between 40 and 50 projects, and almost every project that we get involved with is done on time and on budget. And I believe that is because we use the union labor and the union workforce, and they do the job right the first time. And that's very important. But at the same time, as each individual worker is out there on that job site, when union members get paid, they pay into their health and welfare fund, they pay into their pension fund. So every man hour that gets worked, not only are they getting the return through the investment of the Erect fund investing into the project, but they're also getting basically a secondary investment because their employees are working on the site and paying into that same pension fund that we are using to make their returns for them. So it's kind of like a dual win for them. They're getting something else.
Well, and not only are they getting their pensions and their potential retirement funded, but they're getting paid to do the work.
Absolutely, yes.
Right. So these are union laborers and people that now I don't know how many of them are journeymen and how many of them are, local, but at least while they're working on the project, they're local, and theoretically they're bringing their families, and maybe they buy a house so again, there's beyond the building itself, making the community, improving the community that surrounds it.
Right.
Even further out, you have communities that are benefiting from additional people coming in. The schools benefit because the kids got to go to school.
True,
the restaurants benefit because after mom or dad get off work, they take the family out, they have
Right.
dinner, right? So there's a lot of benefit to not only the building itself and the tenants that occupy it and or whatever, but also just constructing the building requires people. And those people require a community to sort of support them and so forth too. So
If you build it, they will come,
if you yes, there are cornfields around here, but there's but I just think that's an important thing to think about too, is that it's not just, well, so and so's making a bunch of money on a building. It's that building not only grows the community but provides for the community in a lot of ways that aren't directly attributed to that particular project.
Absolutely. Yeah.
You
I
know?
agreed on that. And I will just say, I mean, one of the big things is, put people to work too. I mean, that's the one thing, like I get a tangible, I can see tangibly. That's the one thing I like about what I do, because when we build a building, I can tangibly go there and see the building. I can go and talk to the guys that are working on the building. We actually did something a couple years ago. We haven't done it recently, but we really probably should. We went to a building that was getting built, and we actually catered lunch for the guys that were working on the building. And when we did that, we actually told them, do you guys know that like you're technically owners of this building, because your pension money is invested in this building and is basically yours. And you know what? And what they realized was they actually were like, well, that's really cool. And I wish we would do that more. But we basically tell them, anytime you see a rec fund sign, that means you guys are not just the builders of the building, but you're owners of the building, because your pension fund has an ownership interest in this building.
It's a cool way to think of it.
It is. It's very cool. And they like that.
Yeah.
Yeah, yeah. Work harder and do better, probably.
Yeah. And that's why we're budgeted on time.
Yeah, well, I mean, you're right. I mean, the idea that, hey, if I don't care what it is, if I feel like I have some stake in the whatever it is I'm doing, I'm probably putting in just a little bit more extra effort.
Sure.
Even if I'm very dedicated to my job and I really enjoy what I do and I have a good work ethic, there's still something about, hey, I own this, so there's a point of pride that I want to make sure that it's really done very, very well.
Absolutely. Yeah. And that's what we see with the guys. And honestly, it's nice that they get to see that too, because when you start talking about pension money and stuff like that, it started to get higher up, and you're not, the guys that are doing the work don't get in the weeds of that stuff. So it's nice that they get to hear that too, and they get to see that, because it's different. It's not anything, this is not a normal thing. This is not something that's done everywhere in the country.
Yeah, and you almost wonder. I mean, I know you said there's a high skill set involved in making something like this work, but you would like to think that maybe somebody might parrot this, or there might be other programs out there around the country that could use a program like this.
And the one big, I will say, we've looked at that and we've talked to others. And one of the big things, and to be honest, Western Pennsylvania is a pretty strong union
Sure
area.
Sure.
And the big thing with them is the unions get along really well. The building trades unions they work together very well. And you don't just need the buy-in from the development teams and the general unions. You need the unions to actually be able to work together, because you don't want to have to deal with disputes and things like that. And what we found is some other people that have tried this in other locations, if you don't have that, the unions working together, if you don't have a good team with you, it's very difficult to make this work. So we're almost in kind of a special area, I would say. Where the stars aligned is what I like to say.
There's a nonprofit in New Jersey. Chip Palix is the guy that runs the place, and they basically started out because he worked for a company he worked for Unilever, and he moved to a different part of the state. He wanted to show his daughter what it was like to sort of grow a garden, so they grew a little home garden, and they had some extra food left over, so they took it to the local food bank, right? And so they were like, oh, this is great. So then that happened for 2 or 3 years, and the daughter started getting really like, well, we're going to give this to the food bank, right, Dad? And it was like, anyway, they now have this organization where they ship to like 37 states. They have farms. They partner with farmers in New Jersey to grow food and send it out to people that are in need. And they do it all as a nonprofit. They don't get any money directly from the growth of the farms or anything like that. They tried to do something similar, and the reason I bring this up is because they tried to sort of port that program out into other parts of the country, and it just didn't work. And it didn't work because
Location.
yeah, it was the location and it was the partnerships that he had built with the local farmers. And these farmers, it's called Grow a Row. That's what it's called.
Okay.
And the idea was because they asked the farmers to just set aside a row of their crop to be donated. Right. So to the individual farmer, it really wasn't all that much extra work to grow an extra row or two of corn when you're already growing 30 acres worth, right?
Yeah.
But it was those partnerships that made it work. And when you tried to put it into a different part of the country, even though it's a fantastic idea, it just didn't take off the same way.
And honestly, that's kind of the same thing that we've kind of experienced as well. Is like I do think that it could work in certain places, but you got to find the right city with the right people, the right real estate mix, basically. So it's like, not only do you have to get the unions on board and make sure that, the unions are excited about it, they want to do it, they can work together. But on top of the unions, you also need basically the development teams. They have to be willing to use union labor. They have to be willing to, take this kind of investment. And the other side of it is, does the real estate market support it? Can it support it? I mean, you need a pretty substantial real estate market to kind of make this work. Doesn't have to be the biggest, because Pittsburgh is by no stretch of the imagination the largest. They are one of the smallest, actually.
But Pittsburgh is growing.
It is.
Yep. I mean, I think that they have done a really good job in Pittsburgh of sort of transplanting the idea of the blue collar steelworker being 80% of the population to now tech companies and more modernized stuff that they're doing.
To be honest, like, the thing with Pittsburgh is, like, if you look at it, like, Pittsburgh had a struggle. We all know that, for years that we had a lot of blue collar work, and that went away, and they didn't really know how, but they did a good job of reinventing themselves. But the big thing is, they didn't just go all in on, like, the tech work. One of the big things in Pittsburgh that's working really well is the building trades. The building trades are very big. They're very supportive. And they're huge employers down there in the area. And it's that mix. It's that mix of blue collar work with the white collar tech jobs. It's a much more diversified employment base down there now, which I think is what makes it a good place for this type of I want to say project, but type of investment opportunity.
Yeah, I mean, and then of course you have a lot of the medical in Pittsburgh too. So you have that,
Absolutely. And the medical really is a big push for the unions. It actually builds the unions a lot down there, because if you go down to Pittsburgh, they're always building a hospital somewhere. If you go in a hospital, if it's not a hospital, it's a university, something at the university. You got Carnegie Mellon down there. You have University of Pittsburgh. Those places constantly build too, and they use union labor for that. So that builds a nice, strong building trades. And I feel like Pittsburgh has one of the strongest building trades councils that I've ever seen, although I haven't been around much, but it's definitely one of the best in America.
Well, and I'm sure that has at least something to do with the history in Pittsburgh being a blue collar town.
Absolutely.
100%. I think there's still a lot of pride in working with your hands and doing the building trades and coming from that lineage of grandfathers and fathers.
No, you built that town, yeah.
Yeah, they did. They built their own town.
Yeah.
I mean, you think about any area. I mean, even like we're a little off of Pittsburgh, but I know tons of union people in my family. Like it's a very strong thing around here, and to be honest with you, that's a good thing, because it's diversification. We're not just going to try to turn into a tech hub. Even though, when we build these buildings, we want to attract the Googles and the Facebooks and the Metas and whatnot to be tenants in these buildings, to bring those jobs in. But we still want to build those with good, strong union building trades.
Yeah. And I think that's something too. I mean, you kind of dropped a few names there, but I think that's you work for Ameris, or Ameris is a community bank. We're not a mega bank. We're not a regional bank, but yet at the same time, your community bank can sometimes be doing things that you don't quite realize that they're doing to better your community, and rubbing some pretty significant elbows with companies like what you just named. These are international companies that are benefiting from something that a community bank is helping to provide.
Yeah, we've actually, I name dropped a couple of them, and honestly, those are tenants that are in our buildings today. We have other tenants as well, but it's like those it takes a lot to bring those kind of tenants here. They want the newest thing possible. They want top quality. It's not just, hey, you build a building and you're going to bring a tech company in. That's not the way it works. They want something that benefits them, that benefits their employees. And again, I go back, I keep saying it, but it's the truth, is like the building trades, they know what they're doing and they do an excellent job of not just building the building to the developer's specifications, but they really know how to do it the right way the first time.
Yeah. Well, I mean, I think it's pretty impressive
I learned a lot. Yeah.
Yeah. I always learn a lot, I think, when it comes to this stuff. And you're very good at explaining what it is that you do to somebody like me that maybe, I didn't go to school for finance. I didn't go to school for that kind of stuff, but just understanding that this is something that it seems like it's a win-win-win, and there are very few things like that in this world anymore.
Absolutely. And that's the way I look at it. And that's why I love what I do, because it is a win. It's a win for the building trades. It's a win for the community. It's a win for our bank. It's a win for everybody. Everybody comes ahead. And that, to me, that makes my job easier, because it's easy to tell everybody, hey, let's do this, because everybody's winning. It's like the developer gets what they want. The unions are getting jobs and returns. Everybody's happy. It's very few.
The communities are growing. Yeah. I mean, it's
very few
good
things
stuff.
that can kind of do what we do. And that's why I find it to be extremely cool. And that's why I like what I do. And I've been here for so long. So,
yeah. Well, you can, after you build a few more buildings, you can come back and talk to us about those too. That'd be awesome. No, Justin, thank you very much for coming down and talking to us about this stuff. I think it's fascinating stuff, and it's stuff that, again, I think a lot of people, when we talk about, even on this podcast, when we talk about a lot of the stuff we talk about, it's really at the individual level. And that's the point, is to try to educate about, finances and banking and so forth. But at the same time, your bank is probably doing things you don't even realize. And sometimes those things can be pretty cool.
Absolutely. Hey, thanks for having us on. I love to talk about this. So I hope everybody enjoyed it.
No. No, thanks very much. Appreciate it.
Absolutely.
Yeah.
This podcast focuses on having valuable conversations on various topics related to banking and financial health. The podcast is grounded in having open conversations with professionals and experts, with the goal of helping to take some of the mystery out of financial and related topics, as learning about financial products and services can help you make more informed financial decisions. Please keep in mind that the information contained within this podcast and any resources available for download from our website or other resources relating to Bank Chats is not intended and should not be understood or interpreted to be financial advice. The hosts, guests, and production staff of Bank Chats expressly recommend that you seek advice from a trusted financial professional before making financial decisions. The hosts of Bank Chats are not attorneys, accountants, or financial advisors, and the program is simply intended as one source of information. The podcast is not a substitute for a financial professional who is aware of the facts and circumstances of your individual situation.
When we see a new restaurant, technology, or manufacturing company arrive in our communities, the local television station or newspapers typically make a fuss over the food or the products being produced. Unless the story is about Apple building a $5 billion facility for themselves in Cupertino, time is rarely spent talking about the buildings that house those businesses. Yet, the business wouldn't exist if it didn't have a place to call home. Most small to medium-sized businesses and organizations simply don't have Apple's capital to invest in the construction of their own facilities. So finding investors willing to take on that risk is a vital step towards bringing successful companies and job opportunities into our cities and towns. I'm glad we had a chance to talk with Justin Mazur today and go behind the scenes a bit to see how businesses like Ameriserve and PenTrust help to make construction and real estate projects like that happen. Ameriserve Presents Bank Chats is produced and distributed by Ameriserve Financial, Inc. Music by Schneckmind. Our executive producer is Jeffrey McTavish. If you're not yet a subscriber to the podcast, well, what are you waiting for? You can listen and follow us on any of your preferred podcast platforms, or you can watch the vodcast on YouTube. For now, I'm Drew Thomas. So long.